All right. Very, very good morning, San Mateo Dental Society. Happy Saturday. My name is Dr. Guardia Hariri. I am Investment and Retirement Income Solution Advisor, specialized in working with dental offices in California. And this morning, I have the honor and pleasure to host our tax planning webinar and introduce you to our speaker. With any new political administration, we experience policy changes, especially in our current economy, which is suffering from $28 trillion in debt. Imagine 28 with 12 zeros. That's our national debt. And that's why we should see major changes to tackle this huge debt in our country. So for those of us who earn over $400,000 a year or have to pay capital gain taxes on our appreciated assets, we do need to learn how to make structural changes and also understand if our current entity and our current estate and tax plan is still the right and relevant choice for us. Today, we have the pleasure to learn from our trusted CPA and tax advisor, Mr. Samy Basta, to educate us about the recent changes and the solutions to minimize our tax exposures. Samy brings with him over 20 years of experience in tax strategy, integrated business planning, and business advisory across the real estate, medical, and tech industries. Samy is currently a member of the American Institute of Certified Public Accountants, California Society of CPAs, and California Society of Tax Consultants. And he's also served on the board of directors as vice president and president of San Francisco chapter for the California Society of Tax Consultants that provides tax education to tax practitioners. Ladies and gentlemen, let us welcome our speaker, Mr. Samy Basta.
Thank you very much, Bardia. Good morning, everyone. I'm very excited to spend time with you here this morning, and thank you so much for spending your 1 hour of your Saturday morning. I know weekend is precious to everyone, and I know tax and accounting can be a dry subject, but I promise it's not going to be boring. We're going to make it fun. We're going to dive into your pain points and see how can we help you out. And it's going to be just an eye-opener to what you need to know in the next 3 years of this new administration, and how can you be prepared for that. So with that being said, I will start my presentation here. I hope you guys can see my slides here. Let me know if you can't. So my agenda for today is I want to dive into the most recent tax updates, just to kind of like a refresher of, what happened in 2020, and some of these deductions and credits that got extended to 2021, and how can you maximize those tax benefits. The second part of my presentation, I want to focus on the Biden tax proposed change, where there's nothing in the table right now, as we know, but we know what's the intent. It's not hidden. They already announced the proposed tax change for the next 3 years, what they wanted to do. And then I want to end or wrap it up with looking at your business structure. I'm a big believer that structure is everything for your business. If you don't have the right foundation, if you're not operating in the right vehicle, you are overlooking tax saving, and you can really hurt yourself when you try to plan for your exit. So structure is everything. This is the very first conversation that we have with prospects or clients that they decide to work with us. We sit with you, and the first discussion is about your structure. A structure can impact the risk you're taking. Structure can impact and determine the tax saving that you're entitled to. Structure can determine your exit strategy. There's every structure has a different exit strategy. There is always a pros and cons, and there is no one size fits all. So I really wanted to spend some time going over this. So I want to start with the recent tax updates.
So you want to share Samy, you want to share your screen as well? Sorry.
Oh, I'm not sharing. Okay, I thought so. You don't see my screen here. Let me. Sorry about that. Okay, so here is my screen. My apology. Okay, I got so excited. I forgot to share my screen. Okay, can everyone see my screen here?
Absolutely.
Okay, thank you. Thanks, Bardia. So let's start with the. I don't know why this. Okay, so here we go. I don't want it to. Nope. Okay. So the first one, the first topic that we're going to talk about, as I mentioned, recent tax updates. PPP loan, that was one of the biggest tax saving and financial assistance for a lot of you. I hope that most of you, if it's not all of you, were able to qualify and got some PPP loan. It's sad because when I looked at the last stats for the PPP, I found there is out of $800 billion, about 3.8 billion left in the fund. It's not used. And this is sad because some small businesses could have taken advantage of this money. So I hope that most of you got PPP loan. And now we're talking about the loan forgiveness. So I wanted to also touch on this. I want to touch on the California AB 80. That's also related to California conformity to the federal and the SBA loan forgiveness rules. I want to talk about the employee retention credit. That's the biggest, most confusing, but most lucrative cash credits, refundable credit that's available to you in 2020 and 2021. I want to talk about the extension of the paid sick and family leave. That's also an area where you can also save a few $100s. Establishing retirement plan and extended. That's so crucial, especially because the CARES Act and the American Rescue Act extended the deadline for establishing a retirement plan until the extended filing date. So it used to be only SIP IRA is the only one that permitted to be established by the extension deadline. Now they make it available for all type of employer retirement plan, which is great. So what that means, excuse me, what that means is if you come to, let's say you're running or you're operating as an S corp, right? And you have up to September 15 to file your taxes. If you file an extension by September 15, if you found out that you owe taxes and you wanted to establish a 401k or solo 401k or SIP IRA, you can do that. In previous years, the deadline is only December 31st. So by the end of the tax year, if he missed that deadline, he can establish any retirement plan except for SIP IRA. But they make it available for all retirement plan in 2021. So this is a good news. I also want to talk about, I think I flipped that quickly. Charitable contribution, that's a great deduction that you don't want to miss. And sometimes that's the last resort that you have to minimize your taxable income. And I'll explain that. Business meals also made 100% deductible in 2020 and 2021, 2022. So take advantage of this. Now, since the economy start opening up, people will start going out, it's time to network, it's time to take your staff out, and it's 100% deductible. It's been 50% deductible for at least, as long as I remember, for the last 10 years. They made an exception in 2021 and 2022. So this is a great deduction that you wanted to maximize. PPP loan forgiveness. Okay, so we know, if you remember the rules, you have 24 weeks to spend the PPP loan, and then you have 10 months after the end of the 24 weeks to apply for forgiveness. So let's say the last PPP we had, the first draw and the second draw. I believe the second draw ended in May 2020. So if you applied and got a PPP in May, you have 6 months to use the credit. So that will take you toward like the end of October. And then you have 10 months from October to apply for forgiveness. So by now, most of our dentist clients or small business clients start getting notices from the lenders asking them to either start paying the PPP or apply for forgiveness. You remember the rules to qualify to maximize for the loan forgiveness. You had to spend 60% on payroll costs. Payroll costs that includes wages, vacation pay, sick pay, health insurance paid by the employer, and retirement contribution by employer. These are all qualify as payroll costs. So as long as you spend 60% on payroll costs and the remaining 40% on any other qualified expense, including rent, utilities, then you can, maximize the forgiveness and you can get all the loan 100% forgiven. They made it easy with the form 3508. So mainly any business that has less than $50,000 loan, you don't have to go through the whole list of requirements. You don't even have to provide a list of, the other expenses that you have aside from the payroll cost. So it makes it very easy for, if your loan is less than $50,000, it's a very simple form. Most of the lender website will list a few questions. You answer those questions, you upload the statements, and what should be within like a few weeks, you should get an update about your loan forgiveness. Now, I want to stress out at that point because I have a couple of clients that they forgot to follow up with the lender, and they found out that the lender start hitting their bank account with loan payments. So make sure when you apply, you get the email for updates, confirmation that your application has been submitted. Should be within 3 or 4 weeks after that, you should get the status update, whether your loan is approved, the forgiveness has been approved, or denied for any reason. Well, 90% of our clients got approved for the loan forgiveness, but you need to follow up, make sure you have that confirmation. How long does it take? Average time I've seen it can go take between 2 weeks maximum to 4 or 5 weeks. If you have to fill out the long form, the 3508, then it may take like maybe a couple of more weeks or so. But usually within 4 to 6 weeks, you should get an update. Okay. Moving on to the next slide. I want to talk to you about the ERC credit. That's the biggest, most confusing credit, but it's very lucrative. It's really an easy free cash that you can get from the IRS. Okay, so let's go back to the rules. What's the ERC credit? It's an employee retention credit. It's available for any small business in 2020. If you were in trade and business, active business on March 12th, 2020, any qualified wages that you paid between March 12th, 2020 and before January 1st, 2021 qualify for that credit. Okay, so let's understand that credit. The IRS will give you $5,000 on the first $10,000 of each employee. So let's say you have 10 employees, and each one got paid like $25,000. You can take the first $10,000 for each employee, half of it, that will be 5,000. So 5,000 times by 10, that's $50,000. Well, some may say, well, but I don't have any payroll tax liability. I already paid my taxes. That's fine. You can actually go back and amend those tax return and get that money back. Even if you don't have, even if the amount of credit exceeds your tax liability, it's a refundable credit, so you will get that money back. Okay, so the biggest question is, how do you qualify? Well, we already said that small business, less than 100 employee, and there are two requirement, excuse me, two requirement that you have to meet. The first requirement is your operation must be either partially or fully suspended due to COVID-19. So if there is a government order, whether city, state, or county, which I assume that most of our dentist client, they were forced to shut down, at least in the second quarter of 2020. So either, this, or if you experience decline in revenue by more than 50%. Okay, so how does that work? You go look at your P&L, profit and loss, by quarter in 2020. You compare each quarter to the comparable quarter in 2029. So first quarter in 2020 compared to first quarter in 2029. Same for quarter 2, 3, and 4. If any one of these quarter shows a decline by more than 50% in revenue, you automatically qualify. Okay, so that's easy. What's confusing is they keep changing the rules. So the credit initially when it comes with the CARES Act expired in December 31st, 2020. So you cannot claim that credit after December 2020. They came back and changed the rules, like, well, we'll make it also available for the first and second quarter in 2021. Great, that's good news. So how can you qualify for those credits? So we just, we just closed the second quarter for most of our clients, June 30th. So you need to go compare the first and second quarter in 2021 to the first and second quarter in 2019, not 2020. So again, if you experience any decline in revenue by more than 20%, so that's the biggest change. So they made it easy for more businesses to qualify for the ERC credit. It used to be more than 50% decline in revenue in 2020, but in 2021, you only have to show either the first requirement, it's still in the act, so either partial or full suspension of your operation, or decline in revenue by more than 20%. Okay, so that's easy. You just take first quarter, you finish your first quarter, second quarter, you close your P&L, and you compare the numbers. They also increase the credit amount. So instead of like 50% of the first $10,000 per employee, they make it 70%. So you take the first $10,000 for each employee wages in the first and second quarter, and you take 70% of this. So imagine you have 10 employees in the first quarter, and they all qualify. You take $7,000 of 7, that's by 10, that's $70,000. $70,000 that you can get from the IRS just by applying for that credit. So you want to make sure you work with your accountant. This is a hot area that we knock the door for all of our small business clients. We send emails. We want to make sure that our clients, if you're one of our clients, that we handle your accounting. We take a look and we automatically will tell you if you qualify or not. So you make sure, you talk to your accountant and make sure they look into that credit. The biggest change also in the first and second quarter is they make the credit available per quarter. So the biggest difference in 2020, you only can apply for that credit 50% of the first $10,000 per year. So that's all what you can get, just, $5,000 per employee per year. In 2021, it's $7,000 per employee per quarter. So imagine that if you qualify for the first and second quarter and you have 10 employees, $70,000 each employee each quarter, so $140,000 for the first and second quarter. So you can see that's a very lucrative credit that you don't want to overlook that that credit. They also extend the credit to the third and fourth quarter. So that's also great. The same rules, except that they limit the amount of credit that you can qualify per quarter to $50,000. So in our example, if you have 10 employees in the third or fourth quarter in 2021, and the credit is $70,000, $7,000 per employee, 10 employee, that's $70,000 per quarter. You cannot claim more than 50%, $50,000, which is not bad. You're still getting, a big tax refund, but it's not going to be as lucrative as the first and second quarter. Okay, so I hope that was clear. Let's move on to the R&D tax credit. It really surprises me, especially with high production dental practices. You haven't heard about this credit. I was talking to one of our business partner, and we have a few dentists that they qualify for that credit. This credit made available to any R&D type of work. So someone may say, well, I'm not an R&D, I'm a dentist. Yes, but let me give you just an example of how you qualify. Think about this. If you develop, improve, or innovate. So let me give you an example from your type of work that you do. Did you test any material for or procedure or processes? Testing or evaluating any new different material within your procedure, whether it's you're doing Invisalign or veneers or braces, acquiring or testing new improved processing parameter, creating or testing prototypes, research leading to publication. If you just one of these dentists that you write publication, any improvement that qualify as innovation, development, or improvement can qualify for that credit. Okay, so the credit was made permanent in 2017, not 2017. It can also be claimed retroactively. So if you miss that credit and you qualify, we have one of our clients that we find out that they qualify for the credit. We went back to 2018 and 2019 and claimed that credit, and they were able to get about $36,000 credit. Now you have to have a high production. So usually this credit is available because of the dollar amount. You have to have at least $1 million, close to $1 million production. So if you're one of these high production practices, you should talk to your accountant about the R&D tax credit. It's $1 for $1 credit and can be up to 10% of the R&D cost. So R&D costs can be qualify for wages, payroll wages, salaries, any materials or supplies that you use for your improvement or innovation. So your accountant won't be able to figure this out. You need like a business resource. There are some firms out there that they can help you figure it out, but we can look at your P&L and can qualify you initially, and then we can refer you to one of those services that they can do the study, because you have to have a study to show to the IRS that you qualify for R&D. But again, that's a really good tax saving credit that you don't want to overlook. All right, moving on to the next one, paid sick and family leave credit. This credit initially came as a provision with the CARES Act and expired in December 31, 2020. But then they extended the credit. So here's what they did. In 2021, they said there is no mandate for you to pay paid sick or family leave. But if you wanted to be generous and help your staff, if someone got sick or they are on a family leave, we'll extend the credit to you. So that's great. It makes it like it's not mandatory, but if you decide to paid sick or family leave, then you get the credit. So the credit is $1 for $1. It got extended until September 30, 2021. And if someone, so still here how it works. For paid sick leave, if your staff experience a symptom of COVID-19 or contracted the virus, they can be qualified for $500 a day regular pay up to 80 hours. So if you decided to pay this, again, you're not mandated to do that, but if you decided to pay them, you will get that credit dollar for dollar when you file your payroll tax return. If they care for someone in their family who encountered or contracted the COVID-19, or they have to stay home because they need to take care of their child, then you also are qualified for up to $200 paid per day for the first 80 hours. So either the paid sick or the family leave pay can qualify for this credit. So you need to be aware of that. I already touched on the new retirement plan establishment. So, if you don't have a 401k or solo 401k or SIP IRA, you need to talk to your financial advisor. And you've heard Bardia, he's my personal trusted financial advisor. He helped me a lot and helped a lot of my clients establish the right vehicle for your retirement. And one of the biggest issues that I see with our dentist client is they forget about the retirement. You are one of the top 5 highest pay job in the US. You know that you came on the I believe in 2019. But the problem is, as much money that you make and generate, most of you are, that's my experience with our clients, they forget about retirement. Retirement is, it should be an essential part in your financial planning. You really have to look at, how long I want it to be in the workforce, and when is that right time to exit. Sadly, this year I've seen a couple of cases where a dentist got they got sick and they couldn't continue, and they have to settle or sell their practices, and there wasn't a good deal because they didn't plan for that. They didn't have enough retirement. They have to get someone right away to take over, and it wasn't really it wasn't planned for. So this is something that you really need to start this conversation. I'm not saying you probably wanted to retire next year or next 5 years, but have a plan. Talk to your accountant, talk to your estate attorney, talk to your financial planner, see how much money you have right now, the revenue that is generating, and how much can you put away for your retirement. That's very important subject that you need to plan for. Charitable contribution and meals and entertainments. As I mentioned, that meals in 2021 and 2022 can be deducted 100%. So this is a great time. It's summertime. Economies start opening up. Go out, start networking, see your colleagues, and take your staff out for lunch instead of having a meeting in the office. Maybe you can just treat them for a meal or so, and it's all 100% deductible. The charitable contribution sometimes that becomes the last tool that you have to reduce your taxable income. So if there is any year to be generous, this is the year 2021, because usually charitable contribution in previous years can only be deducted up to 60% of your AGI. This year they make it up to 100%. All right, so let's talk about the new administration, and that's the fun part. We wanted to know what these guys are planning to do and how's that going to impact your practice. Okay, so here's what we know so far. I want to talk about Tax increase on high earner. Biden administration made it very clear that they're planning to increase taxes on any income above 400K. The capital gain elimination with income over $1 million. That's also one of their proposed changes. The 1031 exchange threshold, they also want to eliminate that if the capital gain is more than $500,000. Corporate tax increase, which that's also another big area that we need to understand how is that going to impact you, whether you operate as LLC, tax as an S corp or a C corp. It's a big, huge difference. Or a partnership, how's that going to impact your taxes? The state and local taxes, as living in California here in 2020, 2017, when the Trump tax reform or the TCJA, they eliminate the cap the state and local taxes to $10,000. Most of us, I'll say a lot of, like almost everyone got hurt by this elimination. We used to, like, if you have a state and local tax on your W-2, in addition to your property taxes, that can add up to a big dollar amount. Most of our clients, they were able to deduct up to $20,000, $30,000, $40,000 on their Schedule A, the itemized deductions. After 2017, this is all eliminated and got capped at $10,000. So we haven't heard any talk about the SALT elimination, but and there is a typo here. It's elimination, limitation. I'm sorry, the limitation. That's right. But we all know how politics works, right? So if they have the majority, Democrats, they have the majority in the Senate, then they can pass, any tax changes they wanted. This is going to change, as we know that right now, I think it's like 50-50. If that change in the next year, some of these proposed changes may or may not pass. So we're just keeping an eye on how's the House and Senate's going to look like in 2021, because that will determine a lot of these tax changes and whether they can be, ideally passed or not. State tax modification, I'm going to talk about this, and the elimination of stepped-up basis, which is going to be huge. I can't believe they even thought about that. We have a lot of real estate clients, and I'm sure some of you have a real estate portfolio, and this is going to hurt a lot of people. So talking about the structure. So before I talk about the structure here, I wanted to go back to my last slide here and just touch on okay, we'll talk about the increase in taxes. So what is the plan in increasing in taxes? They wanted, as we know, they wanted to increase the tax rate to 39.6%. Currently, the highest tax rate is 37%. Well, some may say, well, that's probably not going to impact everyone. That's only the top 3 or 5%. That's right. But think about, having a pass-through income coming from your S corp in addition to your wages. And if you're married and your spouse is a high wage earner, you can easily hit, $1 million. $1 million right now, we see it more and more often on a tax return. It's not rare, and the problem is if they increase the taxes on anyone with over $400,000, that's, that's going to hurt a lot of people. Okay, so the question is, well, before I get to my question, I would just want to go over the rest of the points. So elimination of preferential capital gain rates, most of, people love real estate because of the tax treatment. If you maintain your real estate investment for longer than 1 year and you sell it, you're only paying a long-term capital gain, which can be anywhere between 10 and 20%. Also, they're thinking about elimination of like-on exchange with any gain exceeding $500,000. So we also want to talk about this, increase corporate tax rate to 28%. Now, they're talking about the C Corp, not the S Corp. You understand, if you operate as an S Corp doesn't pay taxes except for the franchise taxes that you pay every year to the state of California. But the S Corp doesn't pay income tax. You as a shareholder pay the taxes on your 1040, on your personal income tax. And that's why they call it pass through. So your net business profit pass it through to your personal income tax, and that, added to any other type of income you have, and that's how you determine your tax rate. So they're talking about the C Corp, which is currently at a fixed rate of 21%. Now, if he increase it from 21% to 28%, that's a big hike. Yes, it used to be up to 35%. So 20% is kind of like in the middle, but that's still a big increase. Now, we'll talk about like how can we get around this. Also, they're talking about real estate, and we mentioned that the SALT elimination, state and local taxes, estate tax modification proposal. So right now, we know that your lifetime exemption on the estate taxes is $11.7 million per person. So you can leave up to $11.7 million in your estate, and that wouldn't be taxed. After 2025, according to the TCJA, the Trump tax reform, automatically that 11.7 million will go back to the normal rate, which is going to be $5 million. So that's going to go back. Now they wanted, the Biden plan wanted to change that from 11.7 million to 3.5 million. Well, that's huge. And also they wanted to cap the gift tax rate, the limit to 1 million. So these are new changes. I'm not saying this is going to happen today or next year. We don't know. We don't know if all these proposals will pass the House and the Senate. But these are, things that you need to keep in mind. So, for example, if you are a startup, if you are just, fresh graduate out of, school, and you're looking for a practice to buy, this is a great time to look for a practice right now. Why? Because the interest rate is, at all-time low. You can easily qualify for SBA loan or for even like a traditional, loan from the bank. It's good time to look for practice and buy and finance it right now, because you don't know where the interest rate, when it's going to go up again. Now, if you are, ready to retire or about ready to retire and looking to sell your practice, you really have to think twice. If you're in a process of selling your practice right now, you may want to wrap it up soon before they change the capital gain, because we don't know when these proposed changes is going to happen, right? So if it's going to happen in 2022, and if you're in the process of selling your practice right now, you don't want to, postpone that. You want to wrap it up right now, because I don't think it's highly unlikely that they will go back and retroactively change the tax rate. We've seen that before. We've seen that. But most of the time, if there is a tax benefit, they will go back and make it retroactive. So, for example, if you remember the TCJA, the Trump tax reform, the qualified business income deduction, the Prop 80, they went back and made it retroactive to 2017. So tax benefits usually made available to go back and amend your prior tax years and get those benefits. Tax hikes usually based on the previous on the history of the tax changes, they usually cannot go back and retroactive. They technically can, but usually they don't. So so those are the things that you need to keep in mind, whether you're buying or you're selling. Also, when you sell, you really have to think about, how do you want to sell your practice? Do you want to sell your practice as a whole? Do you want to sell the business? Or do you want to sell, if you are operating as a corporation, you want to sell just the stocks in the business? Or do you want to sell the assets and keep the goodwill and intangible items? It makes a big difference. If they're going to increase the capital gain and you wanted to avoid that, let's say you have you're going to, have a huge capital gain and you don't want to pay high taxes, this year or next year, you might want to think about, selling it, incrementally and do an installment payments, do it over a few years. So your capital gain, you don't recognize the capital gain in 1 year, you can just allocate and pace this over a few years. Another area that you have to look at what type of structure you have. And that's, I'm going to come to this point in my next slide, but I just wanted to make you aware of this is where the Biden administration are planning to do for the next 3 years or 4 years. So you really have to think about what do I need to do to be prepared for it, whether you're growing your practice, selling your practice, buying a practice, those things that you need to keep in mind. Okay, just want to make sure that we're okay on time. And I don't see any questions here. Do we have any questions so far? Are we doing okay? I'm looking at the Q&A. Okay. Okay, please let me know if I missed any question because I don't see any question on the chat or a Q&A. All right. I want to jump into the next slide, which we're going to talk about the business structure. How's the Biden plan can impact your business structure? Okay, and this is my favorite subject to talk about. Sole proprietorship. I've seen, some dentists, they start as a sole proprietorship. Let me tell you 3 flaws that I don't like about this structure. Yes, I agree. It's easy. It's least, it's most cost effective. You don't have to create an entity or deal with paperwork. One of the biggest thing, flaw with this sole proprietorship is if you have a self-employment health insurance and you have a bad year or happen to have a loss, that's usually happen in the first, second, or third year since you're starting your business, you cannot deduct this loss. So that's one of the biggest flaw that I see. Usually health insurance, if we're talking about average health insurance monthly premium, $1,000, $1,200. So you're losing about $12,000, $15,000 deduction on your 1040. Well, some of you say, well, I can take it as in medical expenses on my itemized deduction. If you can itemize, that's right, but it's still also subject to 7.5% of your AGI. So let's say if your AGI is 100K, right? The first $7,500 are not deductible. So let's say if you spend $10,000 on your health insurance premium, the first $75,000 is gone. You only can deduct up to the rest $2,500. So that's one thing. Second, also, if you're running as a sole prop and you have a home office, which a lot of you do that. I know if you're an associate dentist or you're just starting and you're getting paid as a 1099, you cannot deduct the home office if you have a loss in your Schedule C. So that's a second flaw. The third one, which is I think the biggest, is if you running as a sole prop, think about this. You're actually making yourself an easy target for a random IRS audit. Well, don't take my word for it. When you go home, or just right now, if you want to, just go to Google and type, IRS data book. The IRS published those numbers. Look at the ratio, the audit ratio, the collection ratios, the compliance ratios between individual taxes, Schedule C, and S-Corp partnership LLC. You see a big difference. So for all these 3 reasons, I don't think sole proprietorship is really a good structure, especially for you guys. You start, the average client that we have, they have annual production between, I would say, like $1 million, $1.5 million. Maybe some of you just started, but eventually you will grow your business. You don't want it to be in a structure that can hurt you, down the road. Let's talk about the LLC. Do you need to have an LLC? And what is the benefit? What's the pros and cons of LLC? Well, LLC, it's not a federal state legal structure. And that may surprise some of you. The LLC is a state recognized entity. So when you go to the IRS and say, I want to file for the LLC, your accountant will say, or the IRS will say, well, how do you want to tax? How do you want to be taxed as an LLC? So LLC, you file and create the LLC in the state where you're located. And then you have to tell the IRS, how do you want to be taxed? Do you want to be taxed as a C Corp? Do you want to be taxed as an S Corp? If you have partners, you want to be taxed as a partnership. It all depends. So the C Corp and the S Corp are the most popular form of operating vehicles when it comes to the LLC. So you have to make an election to be taxed either a C Corp, or S Corp, or partnership. If you don't make any election, they call it disregarded entity, which means that you're going to be taxed at just a sole proprietor, as if like you haven't, you don't get any tax benefit. Yes, you get the personal asset protection, which a lot of you, wanted to have, and it's always a good thing to have, but there is no tax benefit, because when you give that piece of paper to your accountant, they will file, your numbers on Schedule C, which is like a sole proprietorship. So all your numbers are all over your tax return, and you don't get any tax benefits of having an LLC. So make sure you discuss that with your business attorney, with a savvy accountant, or someone that familiar with your business, to understand the difference between those different type of entities. Now, C Corp and S Corp, and we're getting a lot of calls and emails from clients who are been operating as an S Corp. It's a great vehicle to operate for a few reasons. I can tell you at least the top three. Well, everyone loves S Corp because the income is not subject to SE tax, self-employment taxes. So, when you operate as a sole proprietorship, you pay federal tax, state taxes if you live in California, and then also self-employment taxes, which can add up to about 14.2% after the adjustment of your net self-employment income. So let's say if you gross 300K and you net about 100K, about $14,000 that goes to the IRS. That's in addition to your federal and state taxes. If you change your S Corp to your sole proprietorship to an S Corp income is not subject to SE tax. So that's the biggest tax saving. The second tax saving or benefit is it's a pass-through. So the corporation doesn't pay taxes. You as a shareholder, as I mentioned before, is the one responsible for paying taxes. Now, it has also a side benefit that if you have bad year or first or second year, usually as a startup, if you have a losses, which is very common, you can pass those losses as long as you have bases in your S Corp. You can pass those losses into your 1040, and the losses can offset any other type of income. So if you have, wages, dividend, interest, passive income, you can offset those income with the loss that's coming from the S Corp. S Corp also, when you sell your business down the road, it's not subject to 3.85% the NIT taxes that was enacted as part of the Obama plan. So you're saving roughly about 4% when you sell your practice. So this is all about the S Corp, and the additional benefit that got added with the TCJA, the Trump tax reform, is the qualified business income deduction. I'm sure most of you are familiar with this. So your income, if you're under the income threshold, you can get an additional haircut of 20% on the top of all the other deductions on your net self-employment income. So let's say you net $100,000 from your S Corp, right? And your household's income, taxable income, is on the threshold. I believe this year is, if you're married filing jointly, it's about $329,000. Single is $163,000. If you're under that threshold, you can get up to 20%. And you can see that on the first page of your 1040. So for all these reasons, S Corp is very popular, especially with medical professional. Now, let's talk about the C Corp, how the C Corp compared to the S Corp. The C Corp is a virtual person. So it's you, it's me, it's the C Corp sitting in this room. So the C Corp files its own taxes, pays its own taxes, and there is no direct connection between you and the C Corp. A lot of time we use that structure when you have high wages and high income, and you don't get the benefit from the S Corp. Because see, the biggest problem with the S Corp is you don't have control over how much income flows from your S Corp to your personal income tax. So you make $1 million, you net a $500,000, that $500,000 automatically report in your 1040. You cannot just leave $200K in the corporation and say, I'm just going to show $300,000. You don't have that. That's why they call it pass through. With the C Corp, it's different, because the C Corp, you can actually control how much income you want it to flow to your personal income tax. Why is that important? It's important because, life happens, and every year you have a different life events. So for example, if you're selling your practice 1 year, right, and you wanted to minimize your taxable income on your personal income tax, so you wouldn't be paying a high capital gain taxes, then you have the control of how much wages you can take. So you would probably take the minimum required salary from your C Corp. Well, how about if you need more money? Then you can take it as qualified dividend distribution, which is going to be taxed at a lower tax rate, 15 to 20%. Well, in another year, you're buying a house or buying a practice, or you want to refi, or you just wanted to show more income to get a better loan deal. Then you wanted to take more wages because that's what the lender is looking for. So see, you can actually legally manipulate how much income you wanted to show from your business showing on your personal income tax. One of the biggest benefits that I see with the C Corp is, and we use that strategy all the time, if you or one of your household has a chronic medical or complicated health issue, and you have a lot of medical and dental expenses, probably not dental for you, medical expenses, you can use a C Corp to get reimbursed almost 100% of all your health medical expenses through a plan is called HRA, Health Insurance Reimbursement Plan. So the C Corp allows you as an employee and as a shareholder to get reimbursed 100% of your medical expenses. Well, can you do that with the S Corp? You can, but the problem is all these fringe benefits that you receive from the S Corp, including reimbursement, need to be added up as taxable wages. So let's say if you got reimbursed for $20,000, you have to add it to your W-2 income, which is going to pay additional taxes on that. Not the case with the C Corp. So that's one of the biggest benefits in the C Corp compared to the S Corp. So now you may want to ask just what's the right structure. Now we know that they're planning to increase the corporate tax rate from 21% to 28%. Should I switch to, if you're running as a C Corp, should I switch to S Corp right now? Is that an easy switch to make, or should I just dissolve my corporation, start something new? There's no black and white answer for this. Every situation is different. That's why it's important to have those conversations with your financial planner, someone like Bardia, Hariri, or someone with your accountant, with your business attorney, to see what's the right structure. How do you want to move from here, and how do you want to be prepared for those changes? So the last thing I wanted to leave you with are just a few practice tips. And I've seen this a lot with our dentists. Please look at your number, review your number. I know you're busy, and your day is probably, I don't know how many clients or patient you see, how many employees you have. But it's so important to look at your KPI. And I want you to just keep this in mind, all these key performance indicator that will tell you how are you performing. You can make $1 million, but you can be running at a loss if you're not looking at your KPI. So let me give you an example of what we help our dentist clients to look at. There is a lot of KPIs that you need to look at. I would just want to give you just a few of them. You always wanted to take a look at your average collection. That's probably an easy one. You wanted to take a look at your profit by clients, your availability by clients. So you wanted to take a look at how many new clients are converted to or new prospect converted to new clients. All these ratios that will tell you, and they will point you to the strengths and weaknesses in your performance. So you really have to look at all these KPI on a regular basis. This is something that we do with our dentist client. When we close the quarter, we take a look at all these KPI and we analyze, we drill down on the numbers, and we figure out why your insurance is higher this month, why your wages are low this month, why this number is different than the previous quarter. All these analyses that will open your mind and will help you out to see how you grow from there. You look at any weaknesses area and you want it to improve, and you look at all these strengths that you have in your practice and performance, and you can build up on those. So I want to leave you. I want to wrap up right now. It's 10:58, and I think I see a question here. I'm the owner of my office condo. My corporation pays rent to me. Okay, so that's a very good question, Dr. Shireen. Okay, so Shireen is saying that I'm an owner of my office condo. My corporation pays rent to me. Can I claim the rent in a PPP forgiveness? The rent is, they changed the rules lately. So they say the rent has to be through a third party, not related party. But then they came back and change and say, if you have a home office that you regularly and exclusively use for your practice, or if you have your own, office building and you rent out yourself, you can. So I would say, yes, you can claim that rent with the PPP forgiveness. One thing I just wanted to point out, Shireen, is make sure you have the asset separation. And I've seen that a lot of, with our, dentists, a lot of people, they put the office building, which an asset that should be separated from your business, combine it with their corporation. Guess what? If you get a lawsuit or for any reason you get, any litigation or lawsuit against your practice, you can lose all this. So the right way to do this is you put your office building in an LLC. So the LLC is separate from you. You run it through a different entity as a C Corp or an S Corp, and have the LLC renting the space for you, and you're paying rent to the LLC. By doing this, you accomplish two things. You have that passive income that will grow for tax, for life. So, assuming that you finish you decided to, retire or get out of the practice, you have that passive income that's growing for you. And at the same time, it's separated. You have the asset protection for you. So I just want to point this out. I thought in the state of California, we have to file as an S Corp. Well, you don't have to file as an S, well, as a dentist. Okay, I'm sorry, I'll take that back. medical professional, that is true, because I had that issue with one of our clients. She is an MD, and she filed as an LLC, and that was, she had an issue with the board. So you're right, Dr. Kim, you have to, in the state of California, if you wanted to establish your practice as a corporation, you have to file as either a C Corp or as an S Corp. It's not just an S Corp. It's whatever suits your needs, and depends on all the parameters that we discussed, you know, your AGI, your high income, taxable income, any other household income, that would determine what's the right vehicle for you. So I think these are the only questions I have here. I don't have any other questions. So if you have any other questions, please, I put my email and phone number here. We offer 15% complimentary consultation. You know, if you have any question or about your business structure, you know, ERC, PBP, anything you want to discuss, you know, we're happy to jump in a call, either me or one of my team members to help you out.